So in this brief video, we will talk about the different frameworks. The first one is the control objectives for information and related technologies that has been initiated by IASCA. The second one is the internal control framework that has been initiated by the Committee of Sponsoring Organizations, which is COSO. And the third one, the enterprise risk management, which is also initiated by COSO. The first framework, which we call it COBIT, is actually related to the IT and the information system. It has several principles. First is how to meet the stakeholders' needs, how to cover the enterprise from end to end, how to apply and integrate a system framework, enable a holistic approach on the whole company, and separate governance from management, as you can see it in this frame. What we mean by governance, we talk about the board of directors in general, management, the executive management, and all the employees. And here we say, what are the domains of management process? Actually, COPIT process reference model divide the management process into 4 domains, as you can see them. The first one, plan, which you can see APO under plan. A stands for align, P for plan, and O for organize. So the first point in the management side is how to do proper planning. And the second one, how to build their actual or execution list based on their planning. So how to build, acquire, and implement all the assets to fulfill this plan. The third point is how to run the operation. So how to deliver, service, and support all the operation side. And finally, how to monitor this implementation by monitoring, evaluating, and assessing the performance. So the COBIT model was trying to look at the information system and separate between the governance and the management. This one, by the way, is addressed heavily in the certification of information system auditors. So if you study for that certification, they take this one in a big book and they explain all the details of applying the COPIT and trying to get some reports out of this framework. The second one is COSO framework. As I said, COSO, it's the Committee of Sponsoring Organization. It's a private sector group which is consisting of 5 different organizations. The first one is the American Accounting Association, the AICPA, the Institute of Internal Auditors, the Institute of Management Accountants, and the Financial Executive Institute. The internal control framework defines internal control and provides guidance for evaluation and enhancing internal control system. So based on this framework, the internal control is defined as a process effected by the board of directors, the management, and other personnel. Why? To provide reasonable assurance and not absolute assurance. It's only reasonable assurance regarding the achievement of objective in 3 categories. The first one, as you can see it on the top, the effectiveness and efficiency of operation. The second one, reliability of financial reporting. The third one, compliance with applicable laws and regulations, and this is what you see it on the surface of the cube here in this model. The second point is, which you see it on the face of the cube here, 5 different elements for the framework. The first one is the control environment, and here we talk about the environment at all the levels, starting by the board of directors, executive management, HR department, employees, and all the policies and practices. So for example, the board of directors, they should have experience and they should make delegation. And the management should have philosophy and operating style. And there should be an organizational structure. and each employee should know his authority and responsibility, and the HR department should have policies and practices for recruiting the right people. And if we ensure that all these different parties are working together, they can create a good environment. But then there is some risk, and this is the second phase, which we call it risk assessment. Here we usually have two different types of risks. One we call it inherent risk, and the second one residual risk. The inherent risk is the susceptibility of a set of accounts or transactions to significant control problems in the absence of internal control. So here we say how the control system is discovering the risk. The inherent risk, it says, in the absence of the control, there is some risks. But the residual risk is the risk that remains even if we have internal control system which is currently operating. So we need to differentiate between the inherent risk and the residual risk. And then we need to do some activities to control the risk. And here, as you can see, we try to make segregation of duties where authority should be differentiated from recording and controlling. In this way, we try to differentiate between those who make approval for the request, those who record the request, and those who are in control. So for example, the auditor will come to do some verification, but the accounting department will do the recording, and the warehouse will do the controlling of the items. And the control activities could have two types, which I mentioned at the beginning, either general control or application control. The third one, which is the information and communication. I'm sorry, I'll come to this slide later, but let me go back here. Yeah, for the information and communication, we talk about the process to identify, capture, and exchange of information in the form and time frame that enables people to carry out their responsibilities. The good communication system should identify and record all the valid transactions. When I say valid transactions, I talk about journal entries, for example. Second, describe on a timely basis the transaction in sufficient detail to permit proper classification of transaction for financial reporting. So here we talk about the date in the journal entry. Third is to measure the value of the transaction to record their proper monetary value. And here we talk about the amount in each transaction. Fourth, we determine the time period in which the transaction happened. And here we talk about the date of the transaction. And finally, ensure that the transaction is recorded in the right financial statement. So here we say for the information and communication, if we ensure that the information has entered properly in items like time, amount, account, classification, this will ensure that the information will go smoothly and communicated properly to the different parts. Finally, we try to evaluate the performance by doing some kind of monitoring, where we do internal control evaluation, implement some kind of supervision to ensure that there is some kind of internal control, use responsibility accounting system like budget, monitor the system activity, and track all the purchase software and mobile devices. And this will help us to ensure there is internal control in the company to check the efficiency of the operation, the reliability of the financial statements, and the compliance with rules and regulations. Now let us come to the last part, which is the enterprise risk management, which is similar to the previous framework, but talking more about objective setting, event identification, and risk assessment. So for example, here in this framework, we try to identify the objectives and classify them into 4 different classifications. First, strategic objectives, which is at a high level goal. Second, operational objectives, which is effectiveness and efficiency of the operation. Then we talk about reporting objectives related to the financial statements, compliance objective related to the compliance with rules and regulations. However, in this framework, we talk about event identification, which was not addressed in the IC framework before. The event identification is identify the incident, both internal and external to the organization, that could affect the achievement of the organization objective. So we ask some questions. What could go wrong? How can it go wrong? What is the potential harm and how can be done about it? And then we try to identify the threat and the exposure of the threat, which I mentioned it earlier by talking about the impact and the probability. And for the risk assessment, we try to see the expected loss by multiplying the threat or the impact by the likelihood. And once we identify the objective and the event and see how much risk, then we have to measure our response as a company by doing one of 4 different approaches as a response to the risk assessment. First, the company can reduce the risk by having internal control system, or accept the risk by doing nothing, or share the risk by making insurance on the risk, or avoid the risk, which means don't engage in these activities. And if you go to the textbook, you will find more information about the response the company might have for the risk. So this is in a nutshell the different frameworks that we have it, whether the COPIT for the IT, internal control, or ERM. Please take your time to go through the textbook material and go through this video recording again and try to manage how to differentiate between the frameworks and how to use each one of them. I hope you find this recording is useful to you, and take your time in reading. If you need anything, let me know. Thank you so much. Bye-bye.